Do I think that Carvana is a profitable stock? The answer is no. The stock is down by 98% since its all-time high, and in this video I'll make a case study about the stock from a fundamental basis, but before that I'll explain their quite innovative business model, as it is truly a new way to buy and sell cars. As always set with educational purposes, and it is not meant to be taken as financial advice. Carvana was founded in 2012, and it's an online used car retailer based in Arizona. The company is the fastest growing online used car dealer in the United States, and it's known for its multi-story car vending machines. These car vending machines look quite impressive, I must say. Also, Carvana helps customers to obtain financing and warranty coverage, to purchase the vehicle and schedule delivery or pickup from their desktop or mobile devices. The market size of the used car dealers industry in the United States has grown 2.4% per year on average between 2017 and 2022. So from an industry fundamental basis, the growth is not a lot. The used car dealers industry in the US is the 9th ranked retail trade industry by market size and the 94th largest in the United States. But during the most recent years, the used car industry is lagging in growth compared to the general retail trade industry. In 2022, the total sales of this industry amounted to 146 billion according to IBIS. According to Global Newswire, the global used car market size was valued at about 1.5 trillion USD in 2021. It is projected to reach about 2.75 trillion by 2030, growing at an annual rate of 6.17% during the forecasted period. Asia Pacific is the largest global used car market shareholder, and it's expected to grow at a rate of 9.3% per year. Europe is anticipated to grow at a rate of 10.2% during the forecasted period. So the general industry growth over the next decade will be quite good. When it comes to the US, Carvana is the top leader in online used car sales. The following map shows their business reach across the country. The company is mostly positioned in the East Coast, but it is vastly expanding to the West Coast. They also own ADESA, which is an online auction house for used cars. A very bad catalyst for this sector is that now used cars are starting to fall in prices quite a lot. This can be seen on the Manheim Used Car Index. Over the past 1 year, prices have fallen by 10+%, and a year prior, prices were rising by about 50% on a yearly basis, which is outstanding, and sooner or later, the trend shall revert. I have read the Q1, Q2, and Q3 reports for 2022 of the company, and now I'll share with you how Carvana's business performed during this year, and later I'll make a fundamental analysis to see why the stock has fallen so dramatically. In Q1, they reported their revenue totaled 3.5 billion, an increase of 56% on an annual basis. In Q2, they reported revenue growth of about 16%, and the revenue totaled about 3.88 billion. And in Q3 of this year compared to Q3 of 2021, revenue declined by -3% year on year, totaling about 3.38 billion. This is a major problem. You cannot be valued like an insane growth stock and not have growth. A 16% growth is not enough at all to justify a peak price of around $70 billion. For a company which has never had even a quarter of positive net income or free cash flow profits. When a business has a lack of profits, it is called a business with an unproven business model. The way such a business is funded is either with share dilution, which destroys shareholders' equity and returns, and the other way is by massive debt expansionist policies, which increase the risk for a company. On the following chart, we see the massive expansion of the long-term debt of the company on a quarter-to-quarter basis. Just in 2022, the long-term debts have doubled, going from about 3 billion to more than 6 billion. This is a terrible sign. What is even worse is that even this is not enough for the company to maintain its business, and they need to implement a massive share dilution. The amount of shares over the last couple of years have doubled as well. If I owned 1 out of 10 existing shares 2 years ago, I would have been entitled to about 10% of the company's future profits. Now, if the shares are 20 and I still only own 1 of them, then my part of the company is now only 5%. Quite the loss for me as an investor. The gross profit per unit is a very important metric for Carvana, and it also is on a decline as seen in their latest Q3 report, going from an all-time high of 4.6k to now 3.5k. This is driving their profitability lower and lower, as the net margin suffers quite a lot. Now we are seeing the worst net margins since 2017 when the company went public. Let's now make a quick and easy fundamental analysis. If you liked the video so far and you learned something new, please subscribe to the channel as this greatly helps me and it helps my journey. I would like to start off with the debt management of the company. Their long-term debt-to-equity level is 17.8. This level is abysmal. We want it to be a 0.5 or less, and this is more than 34 times higher, indicating that the debt management of the long-term debt is beyond comprehension. Their short-term debt levels are seen by the current ratio and are okay, standing at about 2.35. This means their current health within the span of 1 year is safe. The company has no capital efficiency, as the ROIC and ROE are negative, due to lack of any profitability. The company has only 374 million in total equity, and the total liabilities are 9.2 billion. So for me personally, even today, after its 98% price drop, the stock is still quite overvalued, as seen by all metrics, and the company has huge problems in the eyes of constant capital needs and very high capital burn rates. In times of higher and higher future interest rates, this is a big risk for me as an investor. This marks the end of my analysis. Make sure to like the video, and if it was useful to you, subscribe for more stock analysis. Goodbye for now, and until next time.